All right. Hello, everybody. It is time to discuss Google and Microsoft and their earnings expectations because we got their earnings. So now we know what to expect because they ended up saying what they had to say. Look, the big thing that we get out of Google and Microsoft is that it looks like the economy is in a good spot, at least for Q2. Both companies did not do bad. Both companies beat expectations on earnings per share and revenue. Both companies, honestly, just some of the most fundamental transformational companies of our lifetime. Did a really good job. Did a really, really amazing job. And we're going to go through their earnings and then we're going to listen to Google CEO. I think that's a little bit more of the important one simply because of how I'm thinking of advertising and macro. And I think Google is going to give us some more inputs on that. So at 5 p.m., we're going to listen to Sundar Pichai and see what he has to say. Let's take a look at their core earnings, and then we'll get a little bit more deeper into it. Google, $74.6 billion in revenue versus $72.7 billion. So they beat revenue expectations by $2 billion. That is not an easy thing to do, and they were able to do it. EPS, they beat by 12 cents a share, $1.44 versus $1.32. The market was very happy. I believe Google stock right now is at 130. Where is it at? 129. It got to 130 at one point. So market is very excited about Google results. Now, Microsoft came in. Market was down initially. That was Snapchat. We'll go to that in a second. Microsoft stock right now, it's recovered a little bit. It's at 348, so it's not as low as is what you see on the screen right here. Initially, they didn't like it. Fell about 2%, 2.69 EPS versus 2.54. So they beat by 15 cents. And earnings on revenue, $56.2 billion versus $55.4 billion. So they beat by about $1 billion on revenue, a little bit less than $1 billion, which is not bad at all. So Microsoft earnings beat on EPS and revenue. Google earnings beat on EPS and revenue. We're going to go deeper into the numbers. And then, of course, you got this bad boy, Snapchat, down 15% after hours. What is Snapchat now? Is it still... it is $10.41. They just keep losing money and they're getting more users, but they can't monetize. Kind of the same problem that Spotify has. And so Snapchat tanks. So outside of Snapchat tanking, which I'll live with Snapchat tanking if we're talking about the economy, the good news is if you are an investor in the stock market, if you have your money in equities, if you are a little bit nervous about what this earnings cycle is going to be like, if Google and Microsoft are any indicator for Q2 big tech earnings, which I would say they're 2 out of 7, and we already had Tesla, which did a great job of the indicators, they did a phenomenal job. Google and Microsoft killed it. And so as a result of that, it doesn't look like the economy is headed in a horrible space going into the next quarter, because the quarter that we're seeing right now, they did a great job. So we're going to open up Google right here. As you can see, $130 after hours, up 6.7%, 6.17%. Google is the big tech that got the least amount of love. It was only up 34% for the year, so now it's up about 40%. So I expected Google to have a little bit more of love if the market recognized some momentum. And Microsoft down 347. It already ran up last week and the week before that to like 368. So it's not that big of a concern that it's down. To be honest, it's down 0.88%. The bigger concern was, were they going to miss on revenue and EPS? And they did not miss at all. I mean, these companies are transformational companies and they did a phenomenal job. Cool. Stephen, Joseph, Cameron, Vincent, Rajan. Hey, man, tuning in with my dad. Shout out to you, Rajan, and Rajan's dad. Thank you for making Rajan so that he could come to the stream. You did a great job there. Go, man. Thanks for your content. Keep doing Finance Junkies. It's my favorite show on YouTube. Yeah, we'll have Finance Junkies at 7 p.m. and we will go deeper into what happened in big tech earnings. Overall, not bad, man. So let me pull up the actual numbers. Let's break down Google a little bit more in depth, and then we'll listen to them more. So second quarter revenue was 7% higher than last year. So they grew 7%, not bad, high single digits. Cloud revenue climbed 28%. 28% year over year. Not bad at all for Google Cloud. So let me just share my screen right here. YouTube ads also beat 7.67 billion versus 7.43 billion. Google Cloud, 8.03 billion versus 7.87 billion. So cloud beat, YouTube ads beat, revenue obviously beat, EPS beat. And then traffic acquisition costs, 12.54 versus 12.37. So they paid a little bit more for the traffic acquisition. I think this is like server capacity, the advertising to get all the traffic, managing the traffic. There's a lot of stuff you have to do when you have, between Google and YouTube, 150 billion visits every month on your two platforms. So A lot of stuff they have to do for that, but not too bad at all. Separately, Alphabet said in the release that Ruth Porat, the company's finance chief, will be leaving that role after 8 years. Okay, so a little bit here and there. The company's other bets, which include life sciences unit Verily and self-driving car unit Waymo, brought in $285 million in revenue, up from 193. Okay, so Waymo's making a little bit more money now. Not bad. We don't know if we don't know if Google Cloud is profitable yet. So I guess when we hear the call, we'll hear if it's profitable. So no update on that. I would assume it has to be profitable. It was profitable last quarter. I doubt they would go back and reverse. But I think this is also why the market is giving love. Cloud revenue jumping by 28% is not bad. I mean, people give GCP a lot of shit. Twitter runs all their stuff on GCP, and they struck a partnership back in like 2019. So GCP and Twitter have had a relationship for a long time, but obviously AWS and Azure are doing a lot better in the cloud computing space. So growing by 28% is not bad at all when it comes to Google. In the context of Microsoft, let's see a little bit more bigger numbers. Okay, so Microsoft is slowing Azure cloud revenue growth, which makes sense because they were beating Google and there's only so much of a market to capture. So you would imagine they slow down just a little bit. Slowed to 26% from 27% in the previous quarter. Nothing crazy, but it is slowing down. Nadella says employees in May that the company won't lift salaries this year. Okay, so no more pay raises, which is actually great for inflation. Jerome Powell should be very happy that wage growth is not going up higher in that respect. During the quarter, Microsoft announced a new chatbot for data analysis that will draw on technology from startup OpenAI. So 2.69 per share, 56.19 billion in revenue. Net income total $20 billion. Wow. So they printed $4 billion more in profits. $4 billion more in profits Microsoft was able to do. That is absolutely phenomenal. Carlos isn't joining. No, he will be on at 7 p.m. 7 p.m. we'll do earnings. He'll be on. He should be on. GCP had positive EBITDA. Okay, that's amazing as well. For so many quarters, it wasn't getting there, so that's a good thing. Microsoft's intelligent cloud segment contributed $23.9 billion in revenue, up 15% and above $23.7.9 billion. So they beat on the intelligence cloud segment of the revenue. This unit comprises Azure, SQL servers, Windows Server, Visual Studio, Nuance, GitHub, and enterprise services. Not bad, man. That acquisition of GitHub was absolutely phenomenal for Microsoft. Azure revenue grew 26% during the quarter. Microsoft doesn't report Azure revenue in dollars. Google parent Alphabet said Tuesday that its revenue from cloud products increased by 28%. So GCP growing a little bit faster than Azure. Obviously, Azure is still bigger in general. And we see the growth there. Now, this is the beautiful thing about Microsoft. You see this big chart that can barely fit on the screen? These are all the different business segments they have. And so Google, you got ads, and you got YouTube, and you got GCP. Microsoft, which is why it's valued at close to $1 trillion more than Google, just has so many different levers they can pull on. You've got Office consumer products, Office commercial products, 365, Dynamics products, cloud services, cloud growth, Windows, Xbox. They have their hardware stuff. They have search and advertising. They sell the Surface Pro. So search and advertising for them grew 10% year over year, which is not that bad. I think that ChatGPT might be kind of included in that a little bit as well, given that it has to do with, well, it might not be search. Bing is probably that. They probably put that into consumer products. Look, it's not bad. Microsoft, Google had an amazing, amazing quarter. Let me pull up Snapchat's numbers for you guys. I looked at them briefly and I was just like, I was thinking, should I get some Snapchat stock, a little bit before the earnings? And then I reminded myself that it's Snapchat. Like, I was on Snapchat in 2012. I was talking to girls in 2012. I was one of the first early users. I loved it, but it's Snapchat. I look at myself at 2012. Did I have any money to buy anything? No. So the monetizableness, the ARPU of Emit was zero. And that's the problem with Snapchat. Daily active users increased 14% year over year to 397 million. Second quarter revenue was 1 billion. Trailing 12 months operating cash flow, 250 million. Trailing 12 months, 81. If you go down here, this is where you see the real numbers. So revenue is down from last year, same time. And again, 2022 was really bad. So for revenue to be down in 2023 compared to 2022, when 2022 was really bad, I mean, I know interest rates are up significantly, but still, it's not good. Operating loss, they lost 404 million. Last time they lost 400 million, so that's up. Net loss, they lost 377 million versus 422 million, so that's down a little bit. Adjusted EBITDA, they were 7 million positive on EBITDA last time. Now they're down 38 million in their adjusted EBITDA. So they went negative in adjusted EBITDA. Free cash flow, down a little bit from, I mean, it's better than last year, but it's still down. Net cash, better than last year, but still down. Non-GAAP diluted net income loss per share, 2 cents. Diluted net loss per share, 24 cents. So the company's losing money hand over fist. And maybe hand over fist is not the most accurate, but it's been losing money since it's gone public. I mean, I was in the library of my college when I saw Snapchat go public, April 17th, 2020, April 2017. Stock price went public at 23, fell to 17. I remember it like it was yesterday because that was the first time I was like starting to look at stocks. And again, look, this DAU increase of 397 million, this means nothing. This doesn't freaking matter. Spotify took a massive dump, down 14%. They grew their MAU by 36 million. The market does not care. Are you profitable or are you not profitable? That whole, 2021, we're going to give you an increase of $20 billion in market cap because you signed Joe Rogan and you paid $100 million. Think about that. The market gave Spotify like $7 billion more worth of market cap the day they paid $100 million to Joe Rogan, because they thought, even though it's not profitable, it's going to grow. Those days are over. And I don't think they're coming back, given interest rates are probably not going to be zero, at least for the next 5-6 years. Maybe 3-4 years, right? So those days are gone. Those days of profitability are absolutely gone. And now you have to actually get profitable, not just being growth. Amit, did you watch Oppenheimer? Not yet. Did not watch Oppenheimer yet. Lusty Picker, thank you for being here. The ARPU was 0. Bro, it was bad. It was Snapchat. Again, now here's the thing. Google's advert. So what implications does this have for the rest of the market? Let's actually take a look at some stocks and Meta and Amazon and see how they're reacting to this. What was I going to say? I was going to say something. So Google's earnings indicate really well for Meta, because they're both advertising businesses. And if Google does well, Meta tends to do well. Most people spend the same on both platforms, even a little bit more on Meta. So Meta's up. Look at that. After hours, up 1.3%, 298 on good Google news. Amazon, who Andy Jassy went on CNBC today. You know what he said? He said, we're the actual AI play, not NVIDIA. He didn't say it exactly like that, but you get my. He was kind of like he's like, people underestimate us as an AI. So he's basically saying we're the guys you need to be worried about. Amazon below 130, up a little bit after hours at 129.29. So Google and Microsoft definitely gave a good ring to the market. Meta is likely going to do well tomorrow because of Google. Snapchat is just in a different situation where their monetizable user base down 19% after hours. Wow. When this ran to 13, I was thinking just a little bit about Snapchat, and then I remembered it's Snapchat. It's still a market cap of 20 billion. You could argue they're losing what is it? Close to $1 billion a year. Yeah, they're losing close to 800 million or something a year. The market's giving them a $20 billion valuation. This was at one point like an $80 stock, and they're losing that much per year. They're losing close to $1 billion a year. It doesn't make sense to me to even be interested in the stock. There's no momentous growth. There's no unique catalyst. There's no set of users that they haven't discovered yet that are so young that are somehow going to collaborate in their advertising networks. They have a ton of content partnerships. They're paying a crap load of money for the people to post content on Snapchat. So if you're a Snapchat creator or you're a Snapchat media company, you're probably making a boatload, but you're making it at the expense of a shareholder who is losing money on this company because this company cannot turn a profit and they cannot figure out how to monetize their user base. To be honest, one could argue that Snapchat is an acquisition target, and Evan Spiegel and the management team is so damn cocky and stubborn. They have never, entertained the idea of this. They have these F-class shares. They really just don't vibe well with shareholders. So for the institutional investors in this stock, it's just really interesting for what upside do you see in Snapchat? Why would you not have your money in Google? Why would you put it in Snapchat? Google's a $1 trillion company. Snapchat's a $20 billion company. Okay, but Google actually makes money. And it's not that Snapchat can't make money. They've been around since 2010. They've been around for a long public company for almost 7 years. Same question with Spotify. At what point is Spotify going to make some money? There's a big red candle right there. So I think this is healthy for the market. The companies that are not making money, the companies that cannot be profitable, the companies that are showing inflated metrics like user growth or DAUs, when none of those DAUs result in a profit, all those DAUs are sucking up sweet shareholder dollars because they're taking too much time on those servers. So all the cloud computing that Spotify or Snapchat has to pay at is coming from my money as a shareholder, because you can't monetize any of that cloud computing because you can't make a profit. So Amazon's really benefiting the most because I think Snapchat and Google and Spotify both use AWS. So at that point, why wouldn't I just buy Amazon? Why am I so obsessed with these growth companies that can't grow profitably? Seems like that's kind of the core issue here. Tanner was wrong on Google. Yeah, Tanner was wrong on Google. Tanner was totally wrong on Google. I was starting to believe him a little bit too. And then I saw those ChatGPT numbers and I was like, oh, no one's using this shit. Yo, I'm not even using it as much as I thought I was using it, bro. I still pay for it. I still use it, but it's not replacing Google. Not happening. So Microsoft will be in a fine space. Spotify is hard due to artists not getting paid at all. Look, real quick, Adrix, by the way, everyone, thank you for being here. In 15 minutes, we will be listening to Google CEO Sundar Pichai, and he's going to be talking live on the earnings call, and we're going to listen to what he has to say. So we'll be going a little bit more deeper into that. Now, here's the thing. I said this on the morning stream, and this is a stat that's going to blow your mind. This is a stat that's absolutely going to blow your mind, okay? The Weeknd had a song called Blinding Lights. Let me know in the chat if you ever heard of this song. 3.02 billion streams. Now, I don't know about you, but it's really hard to get 1 million streams, 100 million streams, 1 billion streams. This guy did it 3 times, 3 billion streams. He made $18 million off that song. That's over the course of 3 years. That's a lot of attention going to Spotify to listen to that song. That was only on Spotify. Spotify paid Meghan and Harry Markle, the guys from the UK, the rich people that want to cry about being rich. They gave them $20 million to do a podcast. They canceled the deal after they paid the $20 million, which is more than the $18 million that The Weeknd got for 3 billion streams, because Meghan Markle didn't feel like doing more than 12 hours of a podcast. She submitted 12 hours to Spotify. First of all, how do you give people the money up front without getting the content first? I mean, like, isn't there some legal Nope. 20 million. Give us a podcast whenever you want. After 12 hours, the deal is canceled, but they still get to keep the money. It's when you're losing $20 million like that for 12 hours of content that no one wants to listen to. Like, it's stuff like that that really makes you question the strategy of a CEO and what they're kind of doing. Now, granted, I think Spotify will be fine long term, to be honest. Don't get me, I'm not really bearish on them, but I don't know how they're going to actually solve this unit economic problem, because a lot of, again, their new users are from India, Asia, that are paying $2 a month for Spotify. So it's just not making a lot of sense. Amit, are you trying to lose weight? Yes, I am. I'm trying to get to 140 pounds by the end of August. That's where I was in college in 2020. And then I got the COVID weight. So I got to get that off me. So hopefully you guys are seeing a little bit of an improvement here. The only investment that Spotify made sense was Rogan. I agree. Rogan was a great investment. Everything else was not the best. Chow Amit, is Tanner wrong on PayPal? No, I don't think Tanner's wrong on PayPal. Tanner is correct on PayPal. Remember, PayPal, a lot of these companies that people are saying will do well, they don't have to grow tremendously, right? Like Palantir has to actually grow into its valuation. PayPal is PayPal. The market just got stupid and threw it away. And so now PayPal just has to literally show, hey, we're alive, we're doing okay, and it should be able to rebound around the range of 100 to 125 in the next year and a half. That's sort of the estimates that I've seen on PayPal. So a lot of these companies, like SoFi, has to actually grow. PayPal doesn't really have to grow. They just have to keep doing their thing and fed off some competition, and they'll be okay. So I think, Tanner's going to be correct on that. Tanner's also wrong on Robinhood. That is correct. He refuses to use the app. That's how you know, like, if you don't want to use the app and actually see the product, you're not going to get the thesis. So you got to be able to do that. Let's look at Robinhood actually after hours. Now, so let's talk about the regionals real quick. Robinhood is down. PacWest, this was the big news in the regionals. It's halted right now. PacWest, this was the stock that went down to like $2 during the Silicon Valley Bank collapse, and people bought a shit ton of it, and they wrote it up to 10, 15. I mean, people made some decent money on PacWest. It came down today to 769. It's down. Hold on, let me look at the daily. It is down. Webull is so stupid when it does this. Hold on, let me do 6 months. There you go. That's a little bit better. So it was at 11. It went to 750 today. So it went down almost 25%. Now there's a bank in California that's buying PacWest, and apparently the offer came in a lot lower than what the market expected, and the market didn't even expect this. Let me pull up that article real quick, and that's why PacWest is down. This is not bad for the regionals. This is actually a buying opportunity, in my opinion, for the regionals, because the market's just like, oh my god, the regionals. It's like, this has nothing to do with regionals. This is just a merger between PacWest and Bank of California. That's what it is, Bank of California. Now, the premium, no one knows the premium yet, so people are estimating the premium is bad, which is why it tanked, and then all the regionals tanked with it, down 27% today. But this is one of those things where it's consolidating, not necessarily where there's some level of crisis within the regional banking sector. It's not a Silicon Valley FRC type of moment, especially because there's nothing unique to PacWest other than the fact that they decided to have a merger with Bank of California. So we will see the impact of this on the regionals in the morning. But Western Alliance is down, Zions is down, Truist is down. A bunch of these companies. Key West is Key down. Key stock is Key down. Yeah, Key down as well as 2% as well. This may actually be a decent buying opportunity for some of the banks, because it really feels like a nothing burger, but It's something that the market decided to kind of throw all the banks away at. Amit has his top button undone. Okay. Are you guys surprised at that? Robinhood is trash, Amit. Robinhood is not trash. You guys don't understand Robinhood. Robinhood is fine. Amit is that short. You guys were talking. Whoa! I look up to the comments expecting good questions, and you guys are literally talking about my height. I did mention my weight though, so that's probably why. Yeah, 140, 5'7". I'm 5'7". The whole music industry is really hard now. I do work in Denmark where 1 million streams is 15% of the population. So the bigger the artists in Denmark still live on minimum wage. Yeah, and that's all across the world. We got Google earnings call in 10 minutes, everybody. So we're gonna get there in a second. All across the world. I mean, like to make 1 million streams on. Oh, here's the other thing. Like Spotify is not the discovery platform people think it is for music or podcasts. So to get to those million people to then listen to make like $7, I mean, like it's one of those things where the consumers win, because for $10 a month to have unlimited music, I mean, talk about the greatest deal of all time. The problem is it's not a business that I would be wanting to bet on over the next 10 years. Like, even if you get to 1 billion users, the record labels are not going to stop taking their cut. The only way this changes for Spotify is they establish leverage over the record labels, like meaningful leverage. And I don't get how I'm a technology company that's commoditized by YouTube, Amazon, Apple, Google, Deezer, all these different apps. And I come to you and say, hey, let me pay you less every time someone streams Beyonce or the Beatles. You would look at him like, are you stupid? Or like, do we just need to take our music off your platform? And so I don't know where the leverage is ever going to come from. Even if Spotify gets more users, I don't know where the leverage comes from. Who is the tallest junkie? It has to be Vitaly, because I think Chris is 5'8" and Carlos is 5'7" as well. So that's yeah, I think Vitaly's the tallest. Are you using Hood? No, the thing I just shared is a Webull, but I use Hood to do my other trades. Any stocks you guys saw today that were really interesting to you that got your attention? Obviously, we had a pretty interesting market in terms of kind of where things played out. Overall, a little bit of a green day. Again, Google and Microsoft doing good. Carlos is 5'7". He told me he's 5'7". But overall, the market doing really well. Google at 130.88 cents. So Google just absolutely killing it. And here's the thing. Google and Microsoft saved the market. Google and Microsoft, we all expected Snapchat to be shit. We all expected Spotify, or I expected Spotify to be shit. I was so close to buying puts on it, but I didn't buy the puts because I was like, maybe the user growth is going to excite the market. But like really in the back of my head, I was like, they're not going to be profitable. And the user growth, like that's the one moment where I should have, like yesterday, I had my finger on the buy button on the put. And I was just like, I know these users are not going to be profitable, but they're going to blow user expectations. And they did. I thought they would get to like 530. They got to 550. So they blew user expectations at the wazoo, but they just weren't profitable. So the companies that didn't do the best, they didn't do the best when we expected it, but the companies that needed to perform, like Google and Microsoft, they did it. They freaking did it. They did what they had to do. And as a result of that, things are going well. SoFi down a little bit after hours. Well, it's up a little bit, but it was down when the PacWest news came out. Palantir at 1655. Palantir CEO Alex Karp released an article on New York Times about the Oppenheimer moment. I still haven't read it yet. But I will read it soon. It's just incredible to be invested in a company where the CEO is doing articles in the New York Times. I mean, it's just apps and articles about shit that actually matters. That article coming out before earnings to me is bullish. It is bullish. I don't think you release an article, acting like a poet in the New York Times and you come out with shitty numbers. So I think it's going to be really good. Do you think SoFi will go over 10 after earnings? I have zero clue, to be honest. And that is the reason why I sold some SoFi options today. Not my options, but some options I held for my sister. I sold about 65 of them, $12,000 worth, because my biggest concern for SoFi is that the market sells off the news. Like, I think it's going to be a great earnings. I think Noto's very excited. He knows what he was able to do this quarter. He's interacting with fans. Everything's great. Bullish, not bullshit, bullish. But the problem is, just like student loans, I remember I saw us go from 950 to 803 the day student loan news came out. And I'm just like, why did this happen? And then I realized, oh crap, yeah, like the market priced in student loans. There was no reason for us to run up on student loans. Obviously, we're recovered, but I don't know if the market is ready to give SoFi the premium, given the banks still hate us because they're all competing with us. There's only a couple of banks that actually like us. The bank, the highest price target is 14. That's probably out of reach. Another one is Truist, who gave us $11, but we already up 60% over the month and over 100% for the past 3 months. And so I don't know if there's that much more room to run, quite frankly. I think by the end of the year, $10, if everything's okay in the macro, that should be fine. But I'm actually a bit worried for us to be able to break 10. Could it happen for a little bit and then we collapse down and get sold off? Yes. But honestly, the more I think about it, the more I'm like, we're up a lot. I don't know if the market's ready to give us the premium that I want to get to. Also, they're not going to be gap profitable this quarter. I mean, like if they show a gap profitability, yes, 100,000% we are above $10 if we get gap profitability. I don't think we're getting it. I think they're going to be a little bit more conservative and give it till Q3, and then we'll get the gap profitability. So it'll be time. Amit, your stock setup looks nice. What are you using to see stocks that way? It's called Webull. I have said it so many times. I should be paid by this fucking company. I should get something from these guys for recommending their software. Webull. It's free, easy to use, and you can get your link in the affiliate down below. There's no affiliate. You can go download it. It's good. It's a good piece of software. SoFi has a history of doing a 2x or 3x beat and tanking anyway. Wedbush is going to lower the price target to $2 and reiterate it 12 times. Yeah. And that's why, look, we got to end the year at like 10 or 11 bucks, or else I don't want to go into 2024 fighting for 10, 12 bucks. I want to end the year at a consolidated $9 to $11. And then 2024, let's get that one fucking rate cut. And then we'll keep going further. But hopefully it's not, in the worst position going further. I want to be able to rant like Amit. Well, you got to have something to rant about. You got to have something that turns you off, not turns you on. And then boom, you'll be able to rant. Did anyone buy Mattel? Yo, what is Mattel stock? By the way, 5 minutes till Google. We listened to Sundar Pichai. This is what I want Sundar Pichai to say. I want Sundar Pichai to literally be like, I want him to be like, so in his opening remarks. So Satya Nadella 3 months ago says that they wanted to invite Google to dance with ChatGPT. But it seems like they haven't even come to the prom. In fact, it seems like they're stuck at junior prom. And what else could it? And we're the prom king and queen. That's what I would say if I was Satya Nadella. That's literally what I would say. And I would wait for the from all the Wall Street analysts being like, oh shit, he went there. Honestly, I think you need a statement like that because Google was perceived to be in an existential crisis for the past couple months. I think you need a real hardcore statement being like, these guys said they wanted us to dance and they didn't make it to the prom. We are at the prom. We are waiting to dance, but guess what? We're a fucking monopoly. No one can dance with it. Okay, I wouldn't say that part because then you're the antitrust, but I would just be like, look, no one's dancing with us. Now, granted, he probably shouldn't say this because he should want more competition in the eyes of the congressman. But if he wanted to make a statement to shareholders, I would say that shit. And I would get shareholders to be like, goodness gracious, this guy's not effing around. Okay, Mattel stock, this Barbie movie thing, it is down 1% today. 6 months, it's up 4%. 1 month is up 16%. Year to date, up 18%. Yeah, I mean, look, this is only because of the Barbie catalyst, $7.49 billion market cap. It's not interesting to me. I was actually talking to a friend who is a female, and she told me she watched the Barbie movie, and she was telling me that it was the sense of women empowerment for her. And I was like, oh, that's really interesting. I was like, oh, so when we go to get dinner one day, then you can pay for the bill and you can write. And if the waitress is a girl, then you can write Barbie stick together on the bill and give her a fat ass tip if you feel so. No, I'm just kidding. But it's this idea of women empowerment, and that's super awesome. I actually don't want to go watch the film, but I couldn't bet on Mattel because of Barbie. Like, I feel like that would be a little unsafe just because Barbie was the catalyst for Mattel. I mean, maybe that's a momentum play, but I don't think I'm smart enough to be able to do anything like that. So, okay, here we go. We've got what do we have? Why don't you use Hood for desktop? Webull's just the better stocks. It's just better to look at stocks, to be honest. Okay, let's get to Google earnings. We're gonna play it right now. They're starting in 2 minutes. This is gonna be big. Sundar Pichai just needs to not say anything stupid, and then the stock might rally more. And again, any stock you own, it is really good that Google has done well. Because if Google did not do well, then every stock in the market, because Google is advertising. And if Google's not doing well, then that means advertising isn't doing well. If advertising isn't doing well, then that means that people aren't buying as much. Like, it's really bad if Google does bad. Like, Google is a big part of the economy. So it's very, very important that Google is doing well. I'm looking at the earnings call right now. Okay, there's playing an ad. I'll pull it up as soon as it's here, and then we'll listen to it. Upstart is up 300%. for the year. Congrats to Upstart shareholders. Look, I know me and the junkies have been a little critical of it. I personally have not cared too much. Chris and Vitaly are more so than the guys that like this stock is kind of dumb. But quite frankly, when you look at it, the net income is going this way and the revenue is going this way and the stock is going this way. It's one of those things that feels like peak bubble. It's down still 84% from the highs, which is why Chris and Vitaly were like, hey, you should really be concerned about the stock when net incomes go like this, but the stock goes up like this. But look, if you're up 300% year over year, then you're up 300% year over year. It's not bad. Or year to date. Let me share the screen. I'll put the volume on once it starts, and then we'll listen to the earnings. We'll listen to what they have to say. I showed up to Barbie, but thought it was Star Wars. I was in a front row in Chewbacca costumes. Yo, ET, I'm serious. I will pay you for comedy lessons, bro. I don't understand how you're that funny in the chat. Like, I literally don't. Every other comment is like hilarious. Weight Watchers is flying. What's Weight Watchers? Weight Watchers stock. Weight Watchers is $9. What? It's up 58% for the month. What the crap? Wow. All right, here we go. Sundar Pichai, Google earnings. We're listening to them, and I'll see you guys right after it's done. Okay, I'll give it a second. It's still doing the music thing. Kind of weird seeing a mid at this hour. Well, I am here. I'll be there tomorrow for Meta. One day will be a Mid TV streaming. That would be so cool. The irony Weight Watchers is running. It's just, that's insane. Mattel must have strong ties with Chinese manufacturing. Oh, 100%. Those Barbies. I remember I used to play with Barbies when I was little. Everyone played with Barbies, and Barbies are a universal product.
Thank you for standing by for the Alphabet second.
All right, here we go. It's time.
Quarter 2023 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 1 on your telephone. I would now like to hand the conference over to your speaker today, Jim Friedland, Director of Investor Relations. Please go ahead.
Thank you. Good afternoon, everyone, and welcome to Alphabet's second quarter 2023 earnings conference call. With us today are Sundar Pichai, Philipp Schindler, and Ruth Porat. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking, and such statements involve a number of risks and uncertainties that could cause actual results to differ materially. For more information, please refer to the risk factors discussed in our most recent Form 10-K filed with the SEC. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thank you, Jim, and hello, everyone. We are holding our call from London today. It's an important hub for us, and I'm excited to spend time with our local teams, including Google DeepMind, as well as leaders and partners from across the region. This quarter, we shared great progress at I/O, Brandcast, and Google Marketing Live, and we are looking forward to Cloud Next in August. The momentum across the company drove our results this quarter. We delivered solid performance in Search and YouTube, and ongoing strong growth in Cloud, where we remain focused on long-term value creation. And we continue our important work to operate more efficiently, creating durable savings to fund investments in our biggest priorities. Today, I'll talk about this momentum, including our continued leadership in AI and our excitement about the evolution of search. At I/O, we
All right, so we got AI at least once. We just heard AI once.
Shared how we are making AI helpful for everyone in 4 important ways. First, improving knowledge and learning. This is our 7th year as an AI-first company, and we intuitively know how to incorporate AI into our products. Large language models make them even more helpful, models like PaLM 2 and soon Gemini, which we are building to be multimodal. These advances provide an opportunity to reimagine many of our products, including our most important product, search. We are in a period of incredible innovation for search, which has continuously evolved over the years. This quarter saw our next major evolution with the launch of the Search Generative Experience, or SGE, which uses the power of generative AI to make search even more natural and intuitive. User feedback has been very positive so far. It can better answer the queries people come to us with today, while also unlocking entirely new types of questions that search can answer. For example, we found that generative AI can connect the dots for people as they explore a topic or project, helping them weigh multiple factors and personal preferences before making a purchase or booking a trip. We see this new experience as another jumping off point for exploring the web, enabling users to go deeper to learn about a topic. I'm proud of the engineering excellence underlying our progress. Since the May launch, we've boosted serving efficiency, reducing the time it takes to generate AI snapshots by half. We'll deliver even faster responses over time. We are engaging with the broader ecosystem and will continue to prioritize approaches that send valuable traffic and support a healthy open web. Ads will continue to play an important role in this new search experience. Many of these new queries are inherently commercial in nature. We have more than 20 years of experience serving ads relevant to users' commercial queries, and SGE enhances our ability to do this even better. We are testing and evolving placements and formats and giving advertisers tools to take advantage of generative AI. Philip will talk more about how we are using generative AI in our ads products to better serve both advertisers and users. Second, we are helping people use AI to boost their creativity and productivity. One example is Bard, our experiment in conversational AI. Since launching in March, it continues to get better. We rolled out a number of exciting features and capabilities earlier this month. Bard is now available in most of the world and over 40 of the most widely spoken languages. We also added Google Lens capabilities so you can take an image and ask all kinds of questions, turn it into code, and more. This new feature has been really popular, and it's been great to see people sharing their experiences. Bard can now read its responses aloud, and you can adjust them for tone and style. We continue to see great interest in using Bard for coding tasks. On productivity, earlier this year, we introduced Duet AI in both Google Cloud and Workspace. It helps people collaborate with AI to code, write, and get better insights from data and more. Today, more than 750,000 Workspace users have access to the new features in preview. Third, we are making it easier for others to innovate using AI. One way is by providing Google Cloud's high-performance infrastructure, optimized for a range of generative AI models. It's being used by thousands of customers and partners to transform their businesses. I'll give an update on the cloud business in just a moment. Finally, we are making sure we develop and deploy AI technology responsibly so that everyone can benefit. Last week, we signed on to joint commitments with other leading AI companies at the White House, building on the principles that have guided our work for many years. To take advantage of the AI opportunities ahead, we've been sharpening our focus as a company, investing responsibly with great discipline, and finding areas where we can operate more cost-effectively. We've made good progress in data center machine efficiency, which will pay dividends as we continue to invest in AI. We continue to slow our expense growth and pace of hiring and ensure our teams are aligned to our highest priorities. This quarter, we reallocated a number of teams, including aligning Waze's ad sales with our existing business organization. We are combining various engineering efforts across core infrastructure and cloud. Products like Bard and SGE are being built by small, fast-moving teams that have been reallocated to these high-priority efforts. Overall, we are actively moving people to higher priority activities within the company, and we continue to optimize our real estate footprint for current and future needs. Next, Google Cloud. We see continued growth with Q2 revenue of $8 billion, up 28%, and operating profit of $395 million. Our AI-optimized infrastructure is a leading platform for training and serving generative AI models. More than 70% of GenAI unicorns are Google Cloud customers, including Cohere, Jasper, Typeface, and many more. We provide the widest choice of AI supercomputer options with Google TPUs and advanced NVIDIA GPUs, and recently launched new A3 AI supercomputers powered by NVIDIA's H100. This enables customers like AppLovin to achieve nearly 2 times better price performance than industry alternatives. Our new generative AI offerings are expanding our total addressable market and winning new customers. We are seeing strong demand for the more than 80 models, including third-party and popular open source, in our Vertex, Search, and conversational AI platforms, with the number of customers growing more than 15x from April to June. Among them, Priceline is improving trip planning capabilities, Carrefour is creating full marketing campaigns in a matter of minutes, and Capgemini is building hundreds of use cases to streamline time-consuming business processes. Our new anti-money laundering AI helps banks like HSBC identify financial crime risk, and our new AI-powered target and lead identification suite is being applied at Cerebral to help enable drug discovery. Our generative AI capabilities also give us an opportunity to win new customers and upsell into our installed base of 9 million paying Google Workspace customers. I mentioned Duet AI earlier. Instacart is using it to improve customer service workflows, and companies like Extend are scaling sales outreach and optimizing customer service. Customers confidently choose Workspace because of the safety and security we provide their distributed workforces. Our AI capabilities are helping us differentiate core products like cybersecurity. We have integrated AI throughout our portfolio, winning organizations like Pfizer, who are using Google Cloud to transform their security operations. Chronicle Security Operations Suite, with Mandiant fully integrated, is helping customers stay protected at every stage of the security lifecycle. In the first half of 2023, we saw a 35% increase in incident response engagements compared to the same period last year. Finally, our AI capabilities are also expanding our partner ecosystem. With hundreds of ISVs and SaaS providers such as Box, Salesforce, and Snorkel, and the world's largest consulting firms like Accenture and Deloitte. They've collectively committed to train more than 150,000 people on Google Cloud Generative AI. Turning next to YouTube. Earlier this year, we shared that revenues across YouTube products were nearly $40 billion for the 12 months ending in March.
$40 billion on YouTube, that thing that we're all on right now. That is incredible.
I'm really pleased with how YouTube is growing audiences and driving increased engagement. YouTube Shorts are now watched by over 2 billion logged-in users every month, up from 1.5 billion just 1 year ago. The living room remained our fastest-growing screen in 2022 in terms of watch time. We are reaching more than 150 million people on connected TV screens in the US and seeing growth and momentum internationally. And on subscriptions, there's good growth. Late last year, we announced over 80 million YouTube Music and Premium subscribers. Signups for NFL Sunday Ticket kicked off in April, and we look forward to hosting our first football season on YouTube this fall. Finally, hardware and Android. Pixel continues to have strong sales momentum. We introduced new Pixel devices at I/O, including Pixel Fold, Pixel Tablet, and Pixel 7a, and we've had a great response. Android 14, our latest OS, will incorporate our advances in generative AI to personalize Android phones. The Pixel and Android teams are working together to advance the latest devices. The Pixel Fold is a great example with its many hardware and software innovations. Before I close, you may have seen that we just announced some exciting news that Ruth is taking on the important new role of President and Chief Investment Officer. As our longest-serving CFO, she has helped guide the company through an amazing period of growth, a global pandemic, and the ongoing economic uncertainty that has followed. I'm excited to continue to work with Ruth, who will lead our 2024 planning and remain as CFO while we do a full search for a successor. So it's business as usual now and no change in approach for the future. I look forward to seeing the impact Ruth will have in her new role, driving our investments, engaging with our stakeholders, and creating opportunities for people and communities everywhere. To close, I'm energized by the pace of innovation and the momentum across the company. With 15 products that each serve 500 million people and 6 that serve over 2 billion each, we have so many opportunities to deliver on our mission. Thank you to our employees around the world for their great work this quarter. Over to you, Philip.
Thanks, Sundar, and hello, everyone. Happy to be here with you all today. Let's jump right into our performance for the quarter. Google Services revenues of $66 billion were up 5% year-on-year. In Google Advertising, search and other revenues grew 5% year-on-year, led by solid growth in the retail vertical. In YouTube Ads, revenues were up 4% year-on-year, driven by growth in brand, followed by direct response, reflecting further stabilization in advertiser spend. In Network, revenues declined 5% year-on-year. Google Other revenues were up 24% year-on-year, led by strong growth in YouTube subscriptions revenues. Let's now take a few minutes to cover our 3 key priority areas: Google AI, retail, and YouTube, which I've laid out in prior quarters as clear opportunities for long-term advertising growth. I'll then turn it over to Ruth for more details on our financial performance. Q2 was a big quarter for Google AI and our ads products. I/O, GML, and Brandcast were a testament to our deep commitment to building cutting-edge tools and solutions that help businesses navigate complexity in real time and deliver the results they need, all while improving the experience for users. Sundar covered some of these innovations. I'll share more. It's worth reiterating that while generative AI is now supercharging new and existing ads products with tons of potential ahead, AI has been at the core of our ads business for years. In fact, today, nearly 80% of advertisers already use at least one AI-powered search ads product. Our approach to AI in ads remains grounded in understanding what drives real value for businesses right now and what's most helpful for users. Advertisers tell us they're looking for a more assistive experience to get set up with us faster. So at GML, we launched a new conversational experience in Google Ads powered by a LLM tuned specifically from ads data to make campaign construction easier than ever. Advertisers also tell us they want help creating high-quality ads that work in an instant. So we're rolling out a revamped asset creation flow in Performance Max that helps customers adapt and scale their most successful creative concepts in a few clicks. And there's even more with PMax. We launched a new Asset Insights and new Search Term Insights that improve campaign performance understanding and new customer lifecycle goals that let advertisers optimize for new and existing customers while maximizing sales. We've long said it's all about reaching the right customer with the right creative at the right time. So later this year, automatically created assets, which are already generating headlines and descriptions for search ads, will start using generative AI to create assets that are even more relevant to customer queries. Broadmatch also got updates. AI-based keyword prioritization ensures the right keyword, bid, budget, creative, and landing page is chosen when there are multiple overlapping keywords eligible. And then, to make it easier for advertisers to optimize visual storytelling and drive consideration in the mid-funnel, we're launching 2 new AI-powered ad solutions, Demand Gen and Video View campaigns, and both will include Shorts inventory. Sundar talked earlier about SGE and our early experiments with new ad formats. We're in active conversations with advertisers, publishers, and partners to get their input on how to make these solutions work best for them, and are excited to test and evolve this experience as we learn more. Let's pivot to retail, where we had a good quarter. Profitability remains a top theme for retailers, so solutions like PMax that drive bottom-line value continue to do well. We also continue to see success in helping businesses unlock efficient growth and deliver on their omni-channel goals. Take Ace Hardware, who tapped into AI-powered search and omnibidding to capture increased seasonal demand leading up to Memorial Day. This drove increases across online sales, store visits, and in-store sales, resulting in 87% year-over-year growth in Omni revenue from Google Ads, and led to one of the largest revenue weeks ever for Ace store owners. Q2 also brought innovation on the consumer and merchant front. We rolled out a new GenAI-powered virtual try-on tool that brings the fitting room experience online. Shoppers can try on women's tops across a wide array of models from brands like Anthropologie, Everlane, H&M, and Loft. Rich, visual, engaging content is a win-win for both consumers and merchants. In fact, product offers with more than one image see a 76% average increase in impressions and a 32% increase in clicks. Our new product studio uses GenAI to help retailers create tailored, eye-catching imagery for free, and we are working towards optimizing for performance. We think this will be a game changer, especially for SMBs who can now create high-quality images to use both across Google and their own sites without spending a lot of time or money. As we continue to make Google a valuable place for merchants to grow their businesses and connect with users, Merchant Center Next is another win. We've seen 2x growth in the number of businesses using Merchant Center in the past 2 years. And we're now simplifying it by automating inventory management and giving a consolidated view of performance insights. Better tools means better growth for merchants and better experiences for users. Moving to YouTube. I've said it before, I'll say it again. YouTube starts with our creators, and it's their success and our multi-format strategy that will drive YouTube's long-term growth. In prior quarters, I've laid out how we think about this, enabling our creators to make a living on our platform with more formats and awesome tools leads to more content, which leads to quality consumption of video content, another big focus of the team. And this leads to better opportunities for monetization and for advertisers to support this incredible ecosystem. As we think about growth, we're focused on Shorts, Connected TV, and our subscription offerings, all of which grew nicely this quarter. Let me double-click into Shorts and CTV. First, Shorts. Momentum remains strong. Watch time and monetization are moving in the right direction. Last year, we introduced ads on Shorts to help drive performance and direct response campaigns via Video Action, Performance Max, and app campaigns. As of Q2, brand advertisers can start testing Shorts ads and awareness campaigns. It's still early days, but we're excited by the results. Laneige, Amore Pacific's #1 premium skincare brand, was an early adopter. It leaned into video reach campaigns and new creative over a 10-day test to drive a 21% increase in unique users reached from Shorts and in-feed, all at a more efficient CPM. Second, Connected TV. Substantial engagement by viewers and ROI for advertisers is driving monetization of the living room. We are very pleased with the growth we've seen and how we're delivering the reach, results, and relevance that businesses are looking for at scale. At Brandcast, we announced 2 new ad offerings for streaming. First, 30-second unskippable ads are coming to YouTube Select, which is landing 70% plus of impressions on the TV screen. 30-second ads are a TV industry staple, and now YouTube is bringing our advanced audience capabilities and unparalleled reach to the format. We're also exploring new pause experiences so brands can drive awareness or action when you hit pause. Looking at YouTube holistically, according to our measurement partners, Nielsen, TransUnion, and Ipsos MMA, YouTube delivers higher ROI than TV and other online video on average. Take the Hershey Company. As part of a multi-year partnership to optimize its YouTube strategy, Hershey's brands have been tapping into CTV, efficient AI-powered formats, and made-for-platform creative, leading to YouTube becoming its #1 ROI driving media partner, producing a 65% plus increase in ROI from 2018 to 2023. One last highlight that bridges the power of YouTube with our continued efforts to bring the best across Google to our partners. With Warner Bros. Discovery, we expanded our multi-year relationship across our entire Android ecosystem, including partnering on the launch of Max, a deepened, mutually beneficial relationship on Google TV, and plans to work together on new surfaces. YouTube's expanded deal for Max, inclusive of a Max NFL Sunday ticket bundle on YouTube TV, also underscores our joint commitment to bring the highest quality content and experiences to our customers. I'll close by echoing Sundar with a huge thank you to Googlers everywhere for their incredible passion and hard work, and to our customers and partners for their continued collaboration and trust. Ruth, over to you.
Thank you, Philip. Before I go into the results, first, Sundar, thank you very much for the opportunity. I'm very excited about the new role, and I look forward to it. So turning to the results, we're very pleased with our financial results for the second quarter, which reflect an acceleration of growth in search and momentum in cloud. My comments will be on year-over-year comparisons for the second quarter unless I state otherwise. I will start with results at the Alphabet level, followed by segment results, and conclude with our outlook. For the second quarter, our consolidated revenues were $74.6 billion, up 7% or up 9% in constant currency. Search remained the largest contributor to revenue growth. Total cost of revenues was $31.9 billion, up 6%, driven by other cost of revenues of $19.4 billion, which was up 8%. Growth here was driven by content acquisition costs, primarily for YouTube subscription offerings, followed by hardware costs associated with Pixel family launches in the second quarter. As noted in our earnings release, the overall increase in data center and other operations costs was partially offset by a reduction in depreciation expense due to the change in estimated useful lives we discussed last quarter. Operating expenses were $20.9 billion, up 4%. Operating income was $21.8 billion, up 12%, and our operating margin was 29%. I will cover our expense and margin performance in our outlook. Other income and expense was $65 million. Net income was $18.4 billion. We delivered free cash flow of $21.8 billion in the second quarter and $71 billion for the trailing 12 months, reflecting improved operating performance, as well as the deferral of certain tax payments to the fourth quarter of 2023, as noted in our earnings release. We ended the quarter with $118 billion in cash and marketable securities. Turning to our segment results, prior period results have been recast for two changes that we made as of the first quarter. First, DeepMind is now reported as part of Alphabet's unallocated corporate costs. Second, we updated our cost allocation methodologies. In the second quarter, we then combined the Brain team from Google Research with DeepMind to form Google DeepMind. Costs associated with the Brain team, which were previously included in Google Services, are now reported as part of Alphabet's unallocated corporate costs. We have not recast prior period results to reflect this additional change. Within Google Services, revenues were $66.3 billion, up 5%. Google Search and other advertising revenues of $42.6 billion in the quarter were up 5%, led by growth in retail. YouTube advertising revenues of $7.7 billion were up 4%, driven by brand advertising, followed by direct response, reflecting further stabilization in spending by advertisers. Network advertising revenues of $7.9 billion were down 5%. Other revenues were $8.1 billion, up 24%, reflecting growth in YouTube non-advertising revenues, primarily from subscription growth in YouTube Music Premium and YouTube TV, followed by growth in hardware revenues, primarily driven by the launch of the Pixel 7a in the second quarter. Finally, Play returned to positive growth in the second quarter. TAC was $12.5 billion, up 3%. Google Services operating income was $23.5 billion, up 8%, and the operating margin was 35%. Turning to the Google Cloud segment, revenues were $8 billion for the quarter, up 28%. GCP revenue growth remained strong across geographies, industries, and products. That being said, we saw continued moderation in the rate of consumption growth as consumers optimized their spend. Google Workspace strong revenue growth was driven by increases in both seats and average revenue per seat. Google Cloud had operating income of $395 million, and the operating margin was 5%. As to our other bets for the second quarter, Revenues were $285 million, and the operating loss was $813 million. The decrease in operating loss was primarily driven by a reduction in valuation-based compensation liabilities related to certain other bets. Turning to our outlook for the business. With respect to Google services, first, within advertising, we were pleased with the acceleration of search advertising revenue growth in the second quarter. Our continued ability to generate
So their ability to continue to maintain search means that ChatGPT really isn't doing anything to them, and I think the market's going to like that for Google and really reward them for that.
sustained growth reflects our unparalleled engineering innovation that creates extraordinary experiences for users and capabilities for advertisers, and delivered with the deep expertise of our go-to-market team. And in YouTube, we saw ongoing signs of stabilization in advertiser spending. We are prioritizing product focus on increasing quality consumption of video content with both shorts and in the living room, which is translating into improved monetization. Second, within other revenues. In our YouTube subscription products, the sustained strong growth in revenues reflects significant subscriber growth. You may have seen that last week we increased subscription prices for YouTube Music and Premium, which underscores the value of the products. Strong year-on-year growth in hardware revenues was due in large part to a timing change, given the Pixel 7a was launched in the second quarter, whereas the Pixel 6a launch occurred in the third quarter last year. Looking ahead, the launch timing change will be a headwind to hardware revenue growth in the third quarter. Play returned to positive growth in the second quarter, driven primarily by a solid increase in the number of buyers. Turning to Google Cloud, we are particularly excited about the customer interest in our AI-optimized infrastructure, our large language models, our AI platform services, and our new generative AI offerings, such as Duet AI for Google Workspace, although we are still clearly in the early days. At the same time, we continue to experience headwinds in the second quarter for moderation in consumption growth as customers optimize their spend. We continue to invest aggressively while remaining focused on profitable growth. In terms of expenses and profitability, we remain very focused on durably re-engineering our cost base. Most evident to date are the actions we have taken to reduce the pace of headcount growth, including the workforce reductions we announced in the first quarter and a slower pace of organic hiring, in part given our focus on reallocating talent from within to fuel our growth priorities. A quick comment on the sequential improvement in operating margins in the second quarter. There are two factors to note. First, the benefit from an acceleration in search advertising revenue growth in the second quarter. Second, the vast majority of the charges related to our workforce reduction and optimization of our global office space were taken in Q1. Finally, as it relates to CapEx, in Q2, the largest component was for servers, which included a meaningful increase in our investments in AI compute. The sequential step up in the second quarter was lower than anticipated for two reasons. First, with respect to office facilities, we continue to moderate the pace of fit-outs and ground-up construction to reflect the slower expected pace of headcount growth. Second, there were delays in certain data center construction projects. We expect elevated levels of investment in our technical infrastructure increasing through the back half of 2023 and continuing to grow in 2024. The primary driver is to support the opportunities we see in AI across Alphabet, including investments in GPUs and proprietary TPUs, as well as data center capacity. With all that said, we remain committed to durably re-engineering our cost base in order to help create capacity for these investments in support of long-term, sustainable financial value. Thank you. Sundar, Philip, and I will now take your questions.
Okay, so overall, a pretty decent call for them, pretty decent earnings. They talked a lot about YouTube, a lot about AI-powered enablement of service. So now let's hear the questions, and let's see where the analysts are trying to get some more clarity over.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Our first question comes from Brian Nowak of Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two. The first one for Sundar. Sundar, I'd be curious to just learn about some of your early learnings and surprises around consumer behavior on how people are using Bard versus search. And what new behaviors or consumer utility are you most excited about as you think about what Gemini could provide for people over the course of the next year or so? And then the second one for Ruth. Ruth, congrats on the new position. One question just about the durable expense comments. I think last quarter you talked about the idea that expenses could grow slower than revenue in 2024. Is that still the right way to think about it? And just to confirm, does that include the impact of depreciation in those comments? Thanks.
Thanks, Brian. I'll take the first part. It's definitely early days, but both across Bard and Search Generative Experience, the feedback has been very positive from our users. I think, we are definitely now, able to serve, I would say, deeper and broader information use cases, which is very exciting. I wouldn't say surprise. So, for example, people really using it for coding, something we understood, but it's definitely on the new side. There's a lot of excitement around we integrated Google Lens into Bard. We have known how big Google Lens can be. We see that in the visual searches we get and how much it has grown over the last 2 years. And so we've been doing this for a while. But definitely that in Bard has been super well received. Is being built from the ground up to be multimodal. I think that's an area that's going to excite users. And I go back many years ago when we did universal search, whenever for users we can abstract different content types and put them in a seamless way, they tend to receive it well. And so I'm definitely excited about what's ahead.
And on your second question, Brian, we are really...
Guys, real quick, Pac West is up 38% after hours after the merger is, I think, approved. It's up 35% after hours on news that the $400 million all stock merged with Bank of California has been agreed on. So it fell like 40% today. If you bought the dip, you're up 40% after hours. So seems like the regionals are fine, and that was an isolated instance for Pac West.
Really pleased with the operating performance in the second quarter. We've been saying for some time that we are focused on revenue growth ahead of expense growth, and achieved that for the first time in some time, and that is cost of sales plus operating expense overall. And we do remain very focused on durably re-engineering our cost base. There are a lot of work streams that are in flight, and I mentioned a couple of them in opening comments. This remains a major priority, as Sundar and I both commented on.
Great. Thank you both.
Thank you. The next question comes from Eric Sheridan of Goldman Sachs. Please go ahead.
Thank you so much for taking the questions. Maybe one for Sundar and one also for Ruth. Sundar, can you talk a little bit about elements of open source versus closed and things like custom silicon and how you're thinking about AI offerings broadly developing over the next couple of years, and what you see as some of the key differentiation points that Google, either through their cloud business or the consumer offerings, are going to bring to market, and how we should think about differentiation playing out to a greater degree in AI in the years ahead. That would be number one. And then Ruth, I'll echo Brian's congrats as well on the new role. Maybe both of you could talk to why this type of role might be important at this point in time for Alphabet, and Ruth, what you're looking to sort of drive into the organization from this new role as you move into it in the fall. Thanks.
Thanks, Eric. On the first part, obviously a big topic. I would broadly say, the investments for AI, when you look at the type of deep computer science work, the talent, we have worked hard to bring to the company. And from the ground up, the infrastructure we have built from the earliest days, Google has been a company. We've thought about the switches in our data centers. Wherever we think we can do the best and get an advantage by innovating, we have chosen to do so. We have done that on AI on the silicon side. But what's important to us is really, stay focused on our users and customers, and support all the innovations that's needed. So, for example, with cloud, we've really embraced open architecture. We have embraced customers wanting to be multi-cloud when it makes sense for them. So, similarly, you would see with AI, we will embrace. We will offer not just our first-party models. We'll offer third-party models, including open source models. I think open source has a critical role to play in this ecosystem. Google contributes. We are one of the largest contributors to, if you look at Hugging Face, and in terms of the contribution there, when you look at projects like Android, Chromium, and so on, Kubernetes, and so on. So we'll embrace that, and we'll stay at the cutting edge of technology. And I think that'll serve us well for the long term. On the second part of your question, first of all, I'm very grateful and thankful to all the work that Ruth has done for the company. It's too invaluable to capture in words. I am super thrilled that she's going to continue on an impactful new role and at the scale of our company with the broad changes in technology. I think it's more important than ever before to engage on these issues globally at scale. And advocate on the economic opportunity of the investments we make across Alphabet and Google. And I'm glad that she's going to continue as CFO, and so no changes there. And we'll take the time to find a successor, and Ruth will be closely involved, not just on that, but also our long-range planning, including 2024. Ruth, anything to add?
Just to underscore, when you ask the point about impact, one of the places Sundar and I have discussed quite a bit is landing well the 2024 capital plan and the multi-year plan, and completing all of the very important efforts we have underway. We're excited about what they mean, setting the company up well to be able to invest for long-term growth. And so we're continuing to execute against those. And then I think Sundar summarized it well. We see technology can make such a difference in the lives of so many and the lives of economies, and to be able to focus on the impact on economic growth and the opportunity for people, for organizations, for countries, I think is a privilege. I'm really excited about it, in particular with this amazing company. And so focusing there, as well as the investments that we make across Alphabet to drive economic growth globally across numerous sectors.
Great, thank you.
Thank you. The next question comes from Doug Anmuth of JP Morgan. Please go ahead.
Thanks for taking the questions. One for Sundar and one for Ruth. First, Sundar, just curious, how do you think about timing for more broadly integrating generative AI into search? And more specifically, what are some of the things you'll need to see to do that? And then Ruth, just on CapEx, the 2Q CapEx lower than expected, as you explained, do you still expect modestly higher CapEx in 23 versus 22? And then I know it's getting a little bit ahead, but how should we think about kind of timing of that real estate and office optimization efforts, through 23 and then also into 24? Thanks.
Look, on the search generative experience, we definitely wanted to make sure we're thinking deeply from first principles. While it's exciting new technology, we've constantly been bringing in AI innovations into search for the past few years, and this is the next step in that journey. But it is a big change, so we thought about from first principles. It really gives us a chance to now not always be constrained in the way search was working before, allowed us to think outside the box. And, I see that play out in the experience. So I would say, we are ahead of where I thought we'd be at this point in time. The feedback has been very positive. We've just improved our efficiency pretty dramatically since the product launch. The latency has improved significantly. We are keeping a very high bar, but I would say we are ahead on all the metrics in terms of how we look at it internally, and so couldn't be more pleased with it. And so you will see us continue to bring it to more and more users, and over time this will just be how search works. And so while it's we are taking deliberate steps, we are building the next major evolution in search, and I'm pleased with how it's going so far.
In terms of CapEx, I tried to lay out sort of the cadence of CapEx, and the point, what's an important one, that the sequential step up in the second quarter was lower than anticipated for the two reasons I noted. One, the work that we're doing around office facilities, and then the delays in certain data center construction projects. But that's why we wanted to be really clear that we do expect elevated levels of investment in our technical infrastructure, and that would be increasing through the back half of 2023, consistent with the comments we've made previously that we had expected 2023 to be higher, and given the slower start at the front half of the year, and then continuing to grow into 2024. And the primary driver of this, as you know well, is to support the opportunities we see in AI across the company, including the investments that we've already talked about, proprietary TPUs, all that we're doing with GPUs, as well as data center capacity. And as we continue to see the pace of innovation accelerate, we just want to make sure we're positioned to address the opportunity across Alphabet. And to the other part of your question, when we look at real estate optimization, that's one of many work streams that are important when we talk about durably re-engineering our cost base to create capacity for investments and support long-term sustainable financial value. And we're continuing to work against that.
Thank you both.
Thank you. The next question comes from Lloyd Walmsley of UBS. Please go ahead.
Thanks a lot for taking the question. I wanted to just follow up on some of the SGE questions and just get a sense. I know it's early, but what are you seeing in terms of monetization, and how do you guys think about that as you scale up the deployment of SGE? I think there's a lot of concern out there that maybe in the short term it's a bit of a headwind, but over the longer term, maybe query growth from a more useful product can kind of make up for that. But how do you guys see that playing out, and what can you share there?
Maybe I can give some color here. We've obviously been focused on bringing this experience and making sure it works well for users. And it's very clear to me, first of all, as a user myself, there are certain queries for which the answers are so significantly better. It's a clear quality win. And so I think we are definitely headed in the right direction, and we can see it in our metrics and the feedback we are getting from our users as well. And the thing that doesn't change with these experiences is that many, a lot of user journeys are commercial in nature. There are inherent commercial user needs, and what's exciting to me is that SGE gives us an opportunity to serve those needs again better, right? And better. So it's clearly an exciting area, and as part of that, the fundamentals don't change. Users have commercial needs, and they are looking for choices. And there are merchants and advertisers looking to provide those choices. So those fundamentals are true in SGE as well. And, we have a number of experiments in flight, including ads, and we are pleased with the early results we are seeing. And so, we'll continue to evolve the experience, but I'm comfortable at what we are seeing. And we have a lot of experience working through these transitions, and we'll bring all those learnings here as well.
All right. Thank you.
Thank you. The next question comes from Justin Post of Bank of America. Please go ahead.
Great. Thank you. Just ask about the cloud. It really looks like revenue growth stabilized despite optimization. So could you talk about the pipeline and the client wins in the quarter, how you felt about those, and then any uptick are you seeing related to AI spending in the total revenues this quarter or in the second half? Thank you.
Thanks, Justin. Okay, it is an exciting moment overall in cloud, because there is definitely a lot of interest from customers on AI, and they definitely are engaging in many more conversations with us. So, I would say, without commenting on the short term, but when I think about it long term, I view the AI opportunity as expanding our total addressable market and allows us to win new customers. Scale of investments that we can directly bring to cloud now. As I said earlier, we have over 80 models across Vertex, Enterprise Search, and Conversational AI, and we are taking all of them, translating it into deep industry solutions. So, I'm excited about it. Second, it gives us an opportunity to upsell and cross-sell into our install base. So, for example, if you think about Duet AI in Google Workspace now, it's a collection of all our generative AI-powered collaboration features. We can bring it and make it available to more than 9 million paying Google Workspace customers. Similarly, Duet AI in Google Cloud, again allows us to go back to our install base and engage in deeper conversations. And finally, I think AI helps us differentiate our core products. For example, if you take a look at cybersecurity, we are deeply incorporating AI to drive profound changes there. So overall, I'm excited, and I view this as a long-term opportunity. And all the investments we are doing in AI across Alphabet, including the work we are doing in Google DeepMind and Google Research on Gemini and so on, are directly applicable to cloud as well. So excited about it.
Great, thank you. Maybe one follow-up for Ruth. Did the infrastructure cloud grow faster than workspaces again this quarter?
So we did. I don't think we commented on that. And yes, in the second quarter, GCP growth was above the growth rate for cloud overall.
Great, thank you.
Thank you. The next question comes from Michael Nathanson of MoffettNathanson. Please go ahead.
Thanks. I have one for Philip and one for Sundar. Philip, can you talk about the ad market? If you step back, you're seeing real signs now of weakness in linear TV, ad agencies, smaller digital companies. They're all slowing, and the macro backdrop's definitely cloudy. Yet you guys have accelerated your growth this quarter. What factors are you looking at? Do you see that would identify why are you growing while others are really struggling and slowing now? And then Sundar, I think you spent over $100 billion on R&D over the past 5 years, and yet there's a narrative that it's so competitive and so expensive to compete going forward. Can you talk a bit about how you're revisiting that R&D spend, any near-term cadence updates you can give us for growth, and any factors that could change the growth curve going forward for research and development spending for you guys? Thanks.
Look, maybe I can comment on the how we think about R&D. And look, if anything, I think two things. We are always committed to driving deep computer science research and innovation. That's the foundation on which the company is built, and taking that and applying it and building new products and services and generating value is the virtuous cycle. And so nothing changes in that fundamental thesis. We are definitely, both, as Ruth mentioned on AI investments, we are going to be committed to making sure we invest to realize the opportunity. But all the work we are doing on efficiency and optimization applies to on the AI side as well. And so we are bringing all that lens there so that we do this responsibly. But no overall changes in our philosophy or approach there. And maybe I'll let Philip comment on the overall market dynamics.
Yes, look, I can't comment on others, but our focus continues, obviously, to be helping customers through whatever uncertainty or complexity they're facing. And a lot of companies are focused on profitability, driving efficiencies, and they're carefully evaluating the effectiveness of their budgets. And our goal is really to help them maximize efficiency and drive strong ROI. And I think we have the proven AI-powered tools and solutions to actually do it. I called out search and other revenues being led by solid growth in the retail vertical. We talked about the DR and brand side on the YouTube side. I think those are the key points I would make.
Thank you.
Thank you. The next question comes from Ken Gawrelski of Wells Fargo. Please go ahead.
Yes, thank you so much for the opportunity. I appreciate that. Can I ask on Performance Max? You've had great success there. Could you talk about any vertical or use case expansions, and how long until we possibly get to the point of more automated AI generated creative and production?
Yeah, look, this is a great question. AI is a foundational component that really allows us to help users, advertisers, partners at scale. And we've been on a journey for years, right, to take the key components of advertising, whether it's bidding, targeting, and creatives, as well as innovation, frankly, in the core advertiser and publisher experiences, and improve them dramatically through AI. And Performance Max is an example of how all this comes together at scale for advertisers. They provide us with a business goal, a set of assets, and we can then take care of the rest to meet consumer demand and really deliver on advertiser ROI. And as you heard at GML, we've seen over many quarters, we continue to build new AI features really on top of this. I think I talked a bit in my prepared remarks about where we're taking some of our products from a Gen AI perspective. And if you take a look at some of the things we announced there, it's fair to say whether you look at our revamped asset creation flow in Performance Max, whether you look at automatically created assets, whether you look at Product Studio and so on, that we're on a right path to deliver some really exciting new innovation in automated, let me call it asset creation in the broader sense.
Thank you.
Thank you. Our last question comes from Mark Mahaney of Evercore. Please go ahead.
Okay. Actually, I'll follow up on that last question, Philip. You pointed out AI has been used to improve the advertising mousetrap at Google for many years. Do you view generative AI as just a material accelerant of your ability to improve return on ad spend for the millions of marketers who use Google? And if you think about where generative AI would have the most impact, could you peel it apart? What's your guess now over the next couple of years where it's going to have the most impact on the creative, on the audience creation, on the campaign optimization? Where do you think the most impact will come from generative AI, just for all your advertising customers? Thanks.
Well, look, as I said earlier, generative AI is supercharging new and existing ads products with really tons of potential ahead. And we're really helping advertisers here make better decisions, solve problems, enhance creativity. And I covered this earlier. For example, we launched a new conversational experience in Google Ads, the asset creation flow in PMax. I mentioned the automatically created assets, the Product Studio, and so on. When I talk to customers, they're very excited about AI and understandably have some questions. One of the top questions is, for example, what's the next best step I should take? And this is a key reason why we launched our Google Ads AI Essentials, which was a big announcement at GML. It's a checklist of simple steps customers can take right now to unlock the power of AI, and it has to do with the foundation of data and measurement. It has to do with taking action with our AI products. And it really is a mindset shift to set up organizations for AI success. So those are just some of the examples. If you extrapolate this going forward, those are some of the examples where I see a lot of upside, apart from the points that Sundar already mentioned.
And I think all of this is before we have multimodal capabilities really in the mix. And so looking at the early innovations there, I think it's going to be an exciting couple of years ahead. Thanks, Mark.
Thank you, Sundar. Thank you, Philip. Congratulations, Ruth.
Thank you. And that concludes our question and answer.
All right, we're done. Not bad. Look, it was good earnings. Let's take a look at the stock real quick, and then we're out of here. What do we got on Microsoft and Google? I mean, they did what they had to do. They said what they had to say. and they did not disappoint. The things that I really like from the call is that their focus on obviously AI. I think we got 93 times. That was the count. 93 times of AI. They actually explained it in a meaningful way at $129.85 after hours. They really explained the implications of what AI has to do with the TPUs, with cloud, with content generation, with advertising and the personalization of advertising. I mean, the explanation of the Hershey's case study on YouTube and the 65% ROI over 5 years because YouTube was able to really find them the best audiences and personalize the advertisements. I mean, it made a lot of sense to me. So, I mean, what they're doing in AI seems to make sense. And people were worried that the server cost for AI, Microsoft now at 351 after hours, so it recovered the 2% loss that it had, would be a lot. But Google's been doing this for a long time. So their server costs weren't actually that crazy to run all of the AI that they're running. And Bard's expansion also, Sundar was talking about, has a lot of different use cases as well. That's been going well. So not bad. It was a pretty good earnings for Google. We'll talk more about Microsoft. We'll be live Finance Junkies in 1 hour on this channel. So go get some food. Be back in an hour. We will discuss Microsoft, Google, and the regional bank stuff that happened with PacWest and a bunch of other stuff. So we'll keep going from there. Good stuff. Thank you, everybody, for joining. I really appreciate it. Please make sure to follow on Twitter, like, and subscribe, or X. Follow on X. And I'll see you guys at 7 p.m. Bye, everybody. I don't think they gave guidance, by the way. I don't think they gave guidance. So I don't know. I guess Google doesn't give guidance, but overall, it was not bad. See you guys at 7. Bye-bye.